So hello, in this video we will learn how to create a DCF model like this. It would be a short session. In next 1 hour we will create this model, and after that you can create or apply this same in any company of your choice. So we will not dig deep into each and every aspects, but I will make you that much capable that you can perform or apply these in any of the company. Yet we will cover the pointers or the basic mistakes that most of the students make. Like, one would be that most of the students directly arrive to equity value by adding the cash and reducing the debt. But there are more components to it. Like, you have to reduce the minority interest, you have to reduce the ESOPs if the company have, and add the non-operating assets. So I will point out the basic mistakes that most of the individuals make so that you can create a better model. So let's begin. So see, I have already done the valuation of Infosys, but for you guys, I will re-perform the whole valuation. So I have a empty template of the same, and we will perform this valuation from scratch. So starting with basic introduction, what DCF is. So DCF valuation is used to find the value of any security or any company basis the three components. First is cash flow, growth, and the risk. So our main focus should be finding these three. Okay. So we will start with finding the risk, which is also known as WACC, weighted average cost of capital. Then we will project the growth for next 10 years and the terminal growth rate. We will discuss what these are. And basis that we will forecast the cash flows, discount them at the discount rate, the WACC that we have calculated, and arrive at the enterprise value and subsequently the equity value. That's our final result. So let's begin, starting with the WACC. So now we will calculate the WACC. WACC consists of two components, cost of equity and cost of debt. Okay, so to calculate cost of equity, we need three components. First is risk-free rate, second is equity risk premium, and third is beta. So to find the equity, so find the risk-free rate, we need to go to search over the Chrome that 10 years government bond yield. Okay, search like this and you will get investing.com. Open this. This is the risk-free rate. Okay, directly pick from here. Uh, just a minute. Okay, so this is our risk-free rate. I will just pick it over here. It comes, it have off. So this is our risk-free rate, which is the 10-year government bond yield, which is considered to be risk-free. Okay, so we take this. Next is our equity risk premium. So equity risk premium, see, what we are trying to find with cost of equity. Cost of equity tells us that what an investor would expect or how much return an investor would would expect for investing in the security or a particular company. In our case, that is Infosys. Okay, so we have included the risk rate. At least if if the individual is taking the risk, he expect the returns to be more than the risk rate. Okay. Next is that equity markets are in general more risky than other instruments like debt. So for that we take the equity risk premium. Okay, so it is a risk premium. It is a premium that an investor charge for investing in equity shares. So for this, there are multiple ways to find it, but we will use search that Ashwath Ashwath Damodaran over the Chrome, and you will get this website. Okay, open this. Go to data. Go to current data, and you will find this. Okay, this risk premiums of other markets. Okay, this is last updated on January, and find India. This is India. Okay, this is the equity risk premium 7.26. This is the equity risk premium. See. Okay, so there are multiple ways, but now you can directly pick from this website. It is very much trusted, I would say. So I would take 7.26. Okay, come over here. Next is beta. So हमने अभी तक क्या क्या किया? सबसे पहले हमने रिस्क फ्री रेट को इंक्लूड किया. Secondly, we have included the risk of an investor for investing in equities, but there would be some company specific risk as well, and that is covered under beta. Okay, so there are various methods to find beta as well, but to go the easy way, and it is a good way. Okay, it's not that it's easy, it's a good way. So we will search directly the company name beta. Okay, you can use this website. It is a good website, top stock research. And so one method of calculating beta is through regression, and this is the regression data. Okay, so you can take this figure, weekly 2-year range. I will pick directly and have it available. Right. Copy go, I guess. Let's try again, and just paste it over. Yes, we got it. So now we can calculate the cost of equity. So risk-free rate plus equity risk premium multiplied by beta. This is our cost of equity. Okay. Next up, we have cost of. It is a return that our debt investor expect. How we can find it? So see, it depend upon how risky the company is. So I will tell you the easy method. Go on to screener. You would be knowing the screener. Let me open it for you. Search for in Infosys screener, and you will get this website. Open this. It is a good website that we would be using for most of the time. Okay, go over the end of this page and you will find the section credit ratings. Open the latest rating. This is of Crisel, which is very much recognized, a very good company, and they have given a rating of AAA. AAA is the top rating that a company can get. Okay, we will search again Ashwath Damodaran and go to the website. And go over data, current data. You will find this. Okay, rating spread interest rate coverage. Open this. Okay, in this, our company is a small, riskier, non-financial service company. No, our company is a big company. 6 lakh crores company. Okay, so it is a big company. So it is a large company, large non-financial service company. So For a triple A rating, the spread is 0.45. ठीक है, pick this from here. You have to see for your company. Okay, just go over this, check the rating, what is the rating, and take that data from here. A small company can be any company which is less than 1 lakh crores or 2 lakh crores. It can be considered as a small company. Uh, okay, so you can directly pick this data from here. So you have to click the spread. Okay, we'll go over here. So to find the pre-tax cost of equity, you need to add the risk-free rate plus the spread. This is our cost of debt pre-tax. Okay, we are assuming the tax rate of 25%. So our post-tax cost of debt, KD. Now, what we need to do is 1 minus this, and we arrive. Oh, sorry, there's a mistake here. Yes. Okay. So this is our cost of debt. Now we have both the components. Now we can find the WACC. How? This is old data that I have just copied. Okay. So total market value of the equity, you can find it from here. Market value of the equity is the market cap. Okay. Market cap is what? Number uh, number of equity shares into market price. So this is our market value. What is the debt portion? So debt portion. So for the debt portion, I will tell you over here, and we need to find the debt. Okay. So in other liabilities, in borrowings, you have this debt. Pick it from here. Okay. And paste it over here. You have both the components, sum it, and equity upon total capital, and same word. So you can see the debt portion is very minimal. Companies are net zero debt company. So calculating the cost of equity. So see its formula. You have to multiply the cost of equity with this figure. Okay. So this multiplied by this plus this multiplied by cost of debt. This is our KD. So now we will move to plotting our actual figures for FY25, and then uh, we will forecast the cash flows. Okay, so for getting the actual figures, what we can do in the screener, click on export to Excel, and you will have a file. Okay, just a minute. We have a file like this. Okay, so first we need sales. We'll copy this, paste this over here. इसमें पता क्या रेफरेंसिंग हो रही है, दैट्स वाई इट्स टेकिंग द रॉन्ग फिगर. दिस इज द फिगर. ओके, so see, along with picking the figures, we also need to analyze the data so that we can make our predictions about the future growth and other, like what, how much would be the depreciation, how much would be the EBITDA margin and all. So for that we also need to analyze the data. What is the past trend, what is the management perspective of the future, all those things. So before moving to actual thing, what I would do, I would add few lines. What this line, and one line before this, one more line before this. Is this much. So here I will write the growth. I need the growth figure. So for growth, what we need to do? This minus this. So this is our growth. So we see that in 22-23 there was a growth of 20% approx, and overall there's a growth of around 986%. Okay, and if you want to see the CAGR, this is CAGR. The 10-year CAGR is 11%, 7-year CAGR is 12%, 5-year CAGR is 12%, and 10% for 3 years. This will help us to determine the future growth. See, we consider offer all the things like capex, margins. We consider two things. First, our prediction is based on past data. Secondly, our prediction is based on the management guidance. We combine these both, and on the basis of that, we forecast for future. So, for analyzing, we are doing so. We are analyzing the past data, and for management view, we will go through the con call. Okay. So, for the sales, I can see that the average sales is around 12%. Okay, we can take the 11 to 12%, and of course it is not consistent. There are periods of high growth and of course the low growth. Okay, so this is one analysis that I want to perform. Next is our margin. This is our EBITDA margin. Remember this divided by our sales, I get this figure around 27% margin है. ठीक है, यस 27% मार्जिन था जो कि फॉल कर गया है, अराउंड 24 पे आ चुका है एट प्रेजेंट. नेक्स्ट वी नीड एबिट. एबिट इज़ वेरी इंपॉर्टेंट. ओके, so EBIT is EBITDA. See, this operating profit is actually EBITDA. Okay, and to find EBIT we will minus depreciation. I need to highlight a very important point over here. Okay, so EBIT do not include other incomes. Let me correct it. Okay, so EBIT, the other name for EBIT is operating profit, and other name for EBITDA is cash operating profit. And these both are from core operations, so they don't include other incomes. Okay, and this is the reason that we include non-operating assets in the last of our DCF valuation, because the whole DCF valuation that we have performed have not included other incomes. I will discuss this in future also, don't worry. So we have arrived to EBIT by reducing depreciation from EBITDA. This is our EBIT. EBIT margin is EBIT upon probably sales. This is EBIT margin. Okay, it is around 21% in FY25. It is also reduced over years. So that's all that I need. Okay, so we have picked the sales figure. Next we need our EBITDA figure. We can pick it from here. Copy tab EBITDA जाएगा. इस पे यही है that you need to press once. Next depreciation is this, right? Yes. Next up we need EBIT. You can directly calculate over here. This minus this, less tax. In this EBIT we will apply 25% tax. So this multiplied by 0.25, and then we'll deduct this tax, add back the okay, and here we will just add them. This is our notepad. After this we reduce the cash outflow occurring because of reinvestment. Reinvestment can be in the form of increase in working capital, or the other way, the reduction in the working capital. In that case, we will actually add it. Okay, the other way can be the capex. So to find change in working capital, before doing that, we will go for the capex. So you can find capex, go over here. Okay, so to make it easy for our future work also, so capex is the amount of fixed assets purchased by the company. So you can go to cash flows in the screener and find this fixed assets purchased, fixed assets sold. Okay. So in our case, the assets sold are zero. Otherwise you have to reduce the assets sold from the assets purchased. Okay. You have to take the net figure. So I will copy the last 5 year data and just paste it over here. Yeah. So these are in negative. I need to make it positive. So just what I will do. This was also negative. I feel. Yes, this was a negative. It was a copy mistake. So what I will do, I will multiply them with negative one. They will become positive. So this is our capex for FY25. This will be here. Okay. And for next, okay, I will come to this. Remember that we have parked the last 5 year capex over here. Last 5 years capex. Capex. Okay. Now coming to change in working capital. So this is our change in working capital plot. So working capital consists of majorly three portions. See, there are two formulas. First formula is current assets minus current liabilities. But we will not be using this because DCF calculates the enterprise value based on operations, and current assets also include other investments. Okay, so for DCF, working capital equals to, I will write for you, uh, working capital equals to debtors, is better term, debtors plus inventory minus payables. Okay, this is the formula for working capital. But in Infosys, it is a service company, so there's no inventory. So our formula would be debtors minus payables. How I will get these figures? See, in the balance sheet under other assets, you can see this trade receivables. Directly pick the last 10 year data because we need to analyze this data. Okay, how we can take the last 5 year data? No, sure. Last 5 year data is sufficient. No, sure. 5 year, 6 year, 6 year, 6 year, 6 year. Okay, this is our 6 year data, and for our payables, you can find it over here. This is our payables last 6 year data. Copy it, paste it over here. If there's any other item, you can definitely include it. In our case, there's no other item. So our working capital would be payable receivables minus payables. We'll drag it through. Down will be change in working capital, this minus this, and we'll drag it through. Okay. Working capital as a percentage of sales can also be analyzed, but just leave it further. So see, you need to understand that the requirement of working capital is directly proportional to the sales. Okay, so let me just get the sales figure as well. uh, here we can find the sales figure. These are the sales figure. Okay, here I will plot the sales figure, and okay, we will calculate this divided by this and drag it. See, higher the sales, more would be the debtors, more would be the inventory, more would be the payables. Okay, so there is a direct relation between sales and working capital. So by this data we can analyze that around 16%. So what but understanding, we can take the median. Okay, median of this, we get around 16.6%. So on an average, company requires around 16% of the sales as working capital throughout the year. Okay, we can draw this nuances or interference from this. So uh, this is good for now. You can pick the working capital of this year from here, and what we have done now will benefit us for our forecasting. Okay, so sorry, this is wrong. We need to take change in working capital. This is change in working capital. Okay, so I would directly link it. That would be better. Link it through this. Okay, this is our change in working capital. Let me clean the formatting. So free cash flow equals to this minus this minus this. Okay, discount rate, present value. So we have plotted the present figures for now. Next step is we have to forecast the future growth. Okay, so for forecasting the future growth, what we see, we have already seen the growth in the past. It is around 10 to 11% basis the CAGR. Okay, let's get the management view. You have not done the research, but I have already gone through the company, so I know that there are some challenges in the recent times because of the tariff, the US tariff, and the less demand in the US and other factors. So all the service companies, Infosys, TCS, growth is somewhat muted, and we can see this in the FY25 results as well, the 6% growth. So management has given, see, you can go through the whole transcript. You will get a PDF like this. So I would suggest that you read it. See, there's the figure. Just want to understand the 2 to 3% guidance. Actually, the company has given the guidance of 0 to 3% growth in FY26. Okay, I have read somewhere this. Our guidance for growth in FY26 is 0 to 3% and the margin of 20 to 22%. Okay, so you will get this data from here. You can also get this data from notes. They are not always refined, but see. Okay, so now we know that management has given the guidance of 0 to 3% for FY26. So we will go with the management. We will take the growth of 2.5% on the safer end. Okay, for FY26. Just a minute, 2.5%. Let's take in just a minute, 2.5. Okay, so we have taken a growth of 2.5%, and we have seen that the long term growth of the company was around 11%, and we assume that this situation is not permanent. This unfavorable situation or the headwind for the company is not will not last in the long term, and company will get back to its normal position, the 11% growth that we have seen. Okay, the CAGR, this figure, this 10 to 12%, 10 to 11%. So in long term, for last 5 years, I am taking the growth of 11%. Okay, and I will just drag it. See, it's completely dependent on your view about the future. But to make it realistic, always refer to two sources: management guidance, sector overview, how the sector is performing, what are the future prospects of the sector. Thirdly, the past data. Okay. So in this 4 year period, we will drastically increase it. So what we can do, we can take it 3, then 5, then see. Let me see what I have taken in the past. Like, see, I have taken the growth of 2.5, 3, 8, 9, 10, and then dragged it to the uh, historical growth rate of 11%. So we will take the same, or you can take any figure. It doesn't matter. 8, 10. Okay. So these are the growth rates. Basis this, we will forecast our revenue. So this is the formula. You can just see this bracket close. This one mistake, and just drag it. This is our revenue. For EBITDA, we have seen what we have seen. Uh, where I was, see, this is our EBITDA margin. It was historically at 27%, but because of reduced pricing power, companies' margin have reduced to 24%. And according to my understanding, this is permanent. Okay, so the more you read about the company, the more better you understand the company. So according to my analysis, the company's EBITDA margin would be in this range of around 24%. So I will take the EBITDA margin as 24%. Okay, so this into 0.24. This is our EBITDA margin. For depreciation, before this, we need to forecast the capex. So for the capex, FY26 capex, see, management has not given any guidance on capex. Okay, so we will assume that company will continue to perform the capex based on the past trend. Okay, what are the past trends? Let me check. This is the past trend. The growth in capex was around 2%, 19%, and a fall of 14%, around 1%. So around, you can take an average of like 3 to 4%. That would be correct figure. See, here also same thing applies. If company has given the guidance that they are planning to have a great capex in next 3 to 4 years, then you have to allocate on that basis. But in our case, there's no such guidance. We can rely on the past data. So for FY26, I can take the average, the median figure better, median figure of past 5 years. Okay, and there's a mistake. Okay, and post that, what I will do, what was the reason for taking the median, was that there may be the instance that company has done extremely high capex on the latest year, but on an average company do not do so. So to eliminate that, we have taken the median of last 5 years. Suppose that we will take a growth of around 5%. Okay, you can take any figure. You can take 4%. Let's take the 4%. Okay, so uh, this 1 plus 0.04 is drag it. So see, now how we will forecast depreciation. So the higher, see, this capex figure will be added to our fixed assets. Okay, so our depreciation will increase at a rate of capex. Okay, so what will be the formula? This, before this I need to do one analysis. What? Come with me. We need to find the percentage of depreciation that we usually charge. Go to balance sheet. This is our net block. Okay, I will just get this figure. This is our net block. Copy this. Come over profit and loss. Where should I paste this? You can paste it here. These are our fixed assets. Okay, remember this. I don't need in percentage. I need in numbers. Okay, here we will find the percentage. So depreciation divided by fixed assets. So we get a figure of around 10%, 15%. So better we can take the median of this. It is around 13%. So on an average, company charge depreciation of 13% on its fixed assets. So we will use this depreciation into bracket sorry depreciation plus bracket this, and we need to apply for 13%, 13.14 I guess, 13.14 of the capex that we are doing year on year. So it comes out to be this. We will just drag it through. You can see the formula again. Okay, so we have taken our last year depreciation and added the depreciation on the new capex at the rate of 13.14%, arriving our new depreciation. Coming to a bit, you can do it like this. Next is tax. Apply the same formula to 25% tax. Okay, there's a mistake I guess. No, it's right. See, we have made one mistake. What is this mistake? There should be plus and we have done minus. So these type of mistakes can happen definitely, but you need to be conscious. Now it's correct. So this will be EBIT minus tax. We have arrived to this figure, adding back the depreciation. So this figure, and then MOPAT. Now we need to find the working capital. It is very easy. We have already done a bit of it. So see there. We have forecasted the sales. See, this is our sales. And we have calculated that around 16.6% is the working capital that is required as a percentage of sales. So just project is basis the sales. So what will be the formula? I will tell you. See this, the sales of FY26 multiplied by this, log this thing. This will be the working capital requirement for FY26 and same go on. Okay, and the difference. Wait, I will just drag it. Okay, this will be our working capital requirement. Check me it's correct or not. It's perfectly fine. Perfectly fine. Now you just drag this because we have already linked it to that data and we get those figures. Okay, all right. We are about to arrive to that figure. Now we need a discount rate. So I will link it for our future references. This is our discount rate and this is our discount rate. To find the present value, we have the formula of this divided by 1 plus a discount rate power of this year. Okay. The reason for taking 0.5, 1.5, 2.5 is that the sales or all the figures or the cash flows are for throughout the year. So discounting them at the end of the year would potentially reduce its value. So to account for that, we take the middle of the year. This is the sum of the present value. That is some formula coming to terminal value. So terminal growth rate is C. We have forecasted the cash flows for next 10 years. But in case of company, we assume that the business will continue to run for for life or till infinity. So it's technically not possible to forecast till that point. So we use another model which is dividend discount model. So terminal growth rate is a rate at which company will continue to grow till infinity. So this rate should be less than 6 to 7% because a company cannot grow at a higher pace than the economy. Keep it realistic. You should always keep it less than 6%. Okay. So in our case, I assume that the future is about IT. So we will assume the growth of 5%. Okay. So our terminal growth rate is 5%. Next, here most students make mistake that they take this present value. We have to take this FCFF the last year. Okay. Then multiply 1 plus the growth rate. Just want to tell you what is the formula for dividend discount model. So it is F1, okay, divided by KE minus growth. This is the formula. I hope. Let me just This is the formula for calculating it. Okay, so terminal value would be this divided by KE. KE over this. Here in this case it is WACC, but in general when we calculate it from dividends, so we use KE. But in our case we wanted to find the overall value of the company, so we will use the WACC. Okay, minus the growth rate. This is our equity value. Better make it WACC. Okay. This is our terminal growth rate at the end of 10th year. Okay, so we need to take it or convert into day zero. Means in FY25 we are standing here. So for that, this divided by 1 plus our WACC and power of 9.5, because the terminal value that we have arrived is at 9.5. So we need to take it to year 0, FY25. So this is our present terminal value, and next enterprise value beforehand, it is the sum of this plus this. Now to arrive to the equity value, we need to make certain adjustments. So first in, so you can directly pick this data from the annual report, but for now I will directly uh, take this to save time. You will find it in notes.com. All these figures are available. Okay. Okay, so we have all the figures. There's one item left, which is ESOPs. So for the ESOP, there are two methods. Either you can reduce by writing here like less ESOPs, or other method is that you adjust it in this figure, the number of shares figure. So we will go with the other method. We will adjust it in the number of shares. Okay. So currently the total number of outstanding shares are, let me see. This is the figure. As per FY25, the total number of outstanding shares are this. Have this copied, paste it. It should be number. And what I need to do, I need to divide it with 1 lakh, 1 crore. Okay. So, okay. This is our total number of outstanding shares. We need to adjust it for our e-shops. Okay. So I have this annual report. This is annual report. In this, you can see what is the issue that currently FY25 annual report is not yet available. So we are taking FY24. So here you can see there's RSU. It is restricted shares. Okay. So we will take this outstanding at the end of FY24. Just paste it over here. Next, ESOPs. Sorry. Next is our ESOPs. Paste it over here. Next is this figure. See, this was 2015 plan and this was 2019 plan. So we will take this figure as well. So we are adjusting it. Okay, so we will add it to the total number of outstanding shares because there are potential shares that may be converted into our shares. Okay, so calculate the sum of this. and then divide it or convert it into crores. This is the figure. I've just added. So, so I will just add it. This plus this is our total number of shares. Okay. Coming to our DCF equity value, it will be the present value plus cash plus non-operating assets minus debt minus minority. Okay. I will tell you the reason why we are adding non-operating assets. Okay. So non-operating assets are our investments or other assets that are not directly used in the core operations of the business. We are including it or directly adding back those assets because the income arriving from these assets were not included while performing our DCF. We have not included other incomes over here. That's why we are directly including our non-operating assets at the end to find the equity value. Okay. For the minority interest, these are those shares of our subsidiary held by other shareholders. So before paying to our equity shareholders, we need to repay that money to our subsidiaries. That's why we have deducted that as well. Okay. I'll just remove this. Yes, it has a value in this. Okay. Now to arrive to value per share, this is our value per share. What is the current market price? Current market price is this is the current market price. The share has increased. This is the current market price. Paste it over here. What is so the company is overvalued? Okay, so it is overvalued by 23%. This reverse DCF is not of much use, but just I will show you how to do it. So DCF value is this current market cap. You can link it from here. Okay, and DCF divided by current market cap around 81%. Okay, that's all in our DCF valuation. The next most important part is doing sensitivity analysis. Okay, to do so, I have just an empty template. There's nothing into it. How to perform it? First of all, we will link it with the value per share, intrinsic value per share. You cannot see it because it's in white color. You can have it for now. Okay. Next, select this whole table. So beforehand, what I will do, I will plot the discount rate or the WACC in this row and the terminal growth rate in this row. Okay. So take this as 5 and it would be 4.5, it would be 4, it would be 3.5. Okay. This side would be 5.5, it would be 6, 6.5. You can take any figure, yeah. You can take it 7. In this, our discount rate was 12.66. Okay. So 12.66. Beforehand it would be 11, it would be 10, would be 13, 15, 80. Okay. Now we will go to data. Under data, data table, and this is the window that we see. So what is asking? Row input cell. So this is our row and it is showing this figure. Okay. So you can directly link it from here as well, here as well. Okay. यहाँ से link करते हैं. Next is column input cell. Column input cell is this terminal growth rate. Good. You have the figures. Okay. So if you see, this is the exact figure, our actual present value that we have arrived. Okay. So for this, I want it to be equal to our current market price. So to understand what should be the terminal growth rate to make it equal to the current market price, just to understand this. So I will increase it to 7.5, a little less, 7.45. So yes, it is very much close now. Okay. So around the growth rate should be around 7.4 to justify the current market price of the company. So this is our sensitivity analysis. We can hide it for better presentation, make it white, and this is our sensitivity analysis. Next, this you can create it. It is this the formatting. We have linked it to the cells. That's all. Okay. Here also, if you want, you can link it with these cells. To what you can do, you can just write 11% and link these cells to that data. It would be easy for our future changes if we want to adjust anything. It would be more easier. Okay. That's all. So that's all in DCF. We have arrived to the value of 1221 rupees and the current market price is 1508 rupees, which is around 23% overvalued. This is just for learning purposes. So don't take it the actual value or so, because it is very much dependent upon your personal perspective. I will show you how the value will change basis your projections, basis your analysis or understanding of the company. So there are various ways to change it. Okay. First is assuming the higher growth. If you think that the future is about AI and Infosys is the leading player or pioneer into it, and this will be the company that will be highly benefited from it, you can assume a higher growth. If I take here the growth of around like 20%, let's take, you are seeing the value is almost equal to the current market price. Okay, so one method is this. Other method is that you feel that company's operating efficiency will increase in future. So currently, company requires around 16% of its sale as working capital, and you have a perspective that company will follow more strict debtor policies and have a more strong hold over its payables, and the overall working capital will fall. In that case, also the value per share will increase. Next can be the capex. If you feel that company is very efficient in utilizing its assets and company do not require any further investment to increase its sales, in that case, this capex amount will be reduced equal to around maintenance capex, which will drastically or improve the present value or the DCF value. Okay. Other way can be that you assume that company is less risky and you can reduce this discount rate. So there are various methods of doing so. Okay, in which these value can vary from person to person or valuer to valuer. But if if you perform it in a more realistic way, your DCF value would not be wrong or unrealistic. Okay. Calculating a DCF value becomes a challenge in new sectors or new companies. Like if I have to talk about e-commerce, quick commerce, at the time when they have just started, at that time, to understand its potential in future, the growth rate in future, when you don't have any past data and the sector is itself emerging. So in that time, it's more on the discretion of the valuer what he assumes about the future. So in that case, generally the value comes very divergent from valuer to valuer. Other than that, in established companies like Infosys, these are generally the same. So that's all in DCF. I hope you liked this video and it added some value to you. Comment down below what you need next, and I will try to come up with the same. Okay. Thank you so much.